In this video, I'm going to show you what a profit and loss statement is, aka the P&L, also known as the income statement. I'll show you what it looks like, what it's used for, and what you'll want to measure to track your business's financial performance. Welcome back to the channel. I'm Business Finance Empowerment Coach Chris Jolly. This video is an add-on for my Financially Free Entrepreneur podcast. A link to that is in the description below. Now, in this video, we're going to dive into the profit and loss statement. This is one of the three main financial statements that you're going to want to make sure you're running regularly in your business, along with the balance sheet and the cash flow statement. Despite the fact that this is a crucial report for understanding the financial health of your business, I'm always surprised at how few business owners know how to use it, do so consistently, don't run it, and in many cases, don't even know what it is. Absolutely scandalous. Look, if you haven't been doing this, it can be our little secret. I promise never to tell anyone on one condition. You take the time and you use this video to fully understand the profit and loss statement and make use of it at the very least quarterly or monthly in your business. Pinky promise you can do that? Okay, let's get going. So an income statement is a financial report which summarizes the revenue and expenses of your business over a given period of time. So a basic P&L could look like this. Let me share my screen here. As you can see, we have the profit and loss statement for a fictitious hotel business. Now, they haven't listed the time period. So for our sake, let's just say that this is the P&L for 1 month. And in it, you can see down here that we have all of our income listed. So this is all the money incoming into the business, all of your income, aka the revenue. Here, the hotelier has broken it down into 4 categories. He's got his accommodations, food and beverages, income from functions, and income from all other sources. Then as you can see in this line here, all of the revenue is totaled up to get you the total revenue or total income for the month. The next thing that you do is you calculate all of your expenses. So here you have many different lines of expenses. Again, they have calculated them all, which is this number here at the bottom, this total expenses. And then in order to find their profit, you go and you subtract the total expenses here from the total income here. And we see that they have a profit in this month of $575,900. Whenever your revenue is greater than your expenses, you've made a profit. If nothing remains and you have less money than you started with, that's called a loss. You're not going to want to do that. All kidding aside though, some months you may take losses in your business, especially early on, and sometimes there may even be good or valid reasons for them. But no business can continue that loses money consistently. You're going to want to do a couple of things. You're going to want to make sure, one, that you can pinpoint any issues in the business that caused you to have a loss in that period. And then 2, you're going to make sure you learn from it so that you can do what's necessary to bring more money into your business. Now let's pause to make an important distinction about the types of profit. So you've got your gross profit, which is your revenue minus your cost of goods sold. Now, if you're in a product-based business, the cost of goods sold is the stuff like the actual raw materials that go into making what you sell. It's also the labor that goes into producing that item. So in order to find your gross profit, you take the total amount of income that you had for the month, and then you subtract your cost of goods from it. The next type of profit that you have is your operating profit. Your operating profit is your gross profit minus the operating expenses. So you've got 2 kinds of expenses. You have the cost of goods or the cost of service, and then you have your operating expenses. So if you have a warehouse and you have to pay rent, if you are carrying insurance for your business, your utilities, all of these different costs get subtracted from the gross profit in order to get your operating profit. So you start with all of your revenue, then you subtract the cost of goods or cost of service, and then you also subtract your operating expenses, and that will give you your operating profit. Now, we're almost there because you don't have your net profit quite yet. That's the next type of profit. Your net profit is when you take that gross profit and you subtract out the operating expenses like we talked about, but then you also take out taxes and any interest you owe on short-term loans and things of that nature, because you have to take out the rest of the money that you actually owe to find out how much is left. So another way to look at that is it's just your total revenue, all of the income minus your total expenses, everything from a paperclip on up to your tax bill. Okay. And then the last piece of information that we can find is our profit margin. So we can use this to determine how profitable a product is or how profitable our business is as a whole. So if I have a product that I buy for 20 cents and I sell it for $1, then I know that my profitability on that is 80%. You just take your net profit and you divide it by your total revenue, and then you multiply it by 100 to get that percentage. Since it's important to know if you're profitable, most businesses will benefit from running a monthly P&L. Indeed, this is what I recommend, unless you run certain types of businesses, like a restaurant, for example, where you'll probably want to run one every day. Now, at the end of the fiscal year, it'll be time to run an end of the year P&L. And the great thing about inputting and collecting data every month into your P&L is that it lends itself to be able to easily create sales and expense projections, as you'll have your past data to go by, as well as a better sense of what to expect based upon the experience that you have doing sales cycles in your business. You are doing sales and expense projections, right? Okay, okay. No need to get overwhelmed, even if you're not, and you're not even doing a P&L yet, and this sounds like a lot to you. We're going to break it down real simple and leave you confident knowing what the heck this thing is, how and why you might want to use it in your business. And then once you've got it figured out and you've had some practice with it, you can learn how to use that knowledge and leverage it to create your financial projections. All right, so let's break this thing down. I have this sample profit and loss statement for this fictitious hotel that I've just pulled off the internet. As we saw before, it's pretty generic and doesn't say the time period. So again, we're going to assume that it's just a 1 month P&L. As you can see, in the top section of the P&L, there's the revenue. This is the money that has come into the business that we touched on. Now, how many different lines you'll need for revenue will depend upon the type of business you run. In this example, we've got a handful of pretty generic categories. If you wanted to, though, these could be broken down even further. The hotel owner could include rows for different types of accommodation, like how much money came in for a regular room versus how much money comes in for their suites. The food and beverage category, they could break down and subdivide it into room service sales, alcohol sales, food and beverage sales for the restaurant. So what it looks like for your business will highly depend. Maybe you're an online coach or consultant with just a handful of different offerings. Thus, you could itemize your categories and have 5 revenue lines for each of your 5 offerings. But maybe you're a brick and mortar shop with 200 plus or 2,000 even different SKUs, right? In which case, the best and maybe only sane way to go about it is break it down into category. So your P&L could display total revenue in different sales departments like lawn and garden, tools, and household, things of that nature. All right, here. How many lines you'll need for revenue, and the same will hold true for expenses, is up to you and your business and the industry that you're in. So your own experience with doing sales inside of your business should give you a pretty good idea of where to start and how specific you'll want to get in different areas. Maybe you only sell 2 products. In that case, you'll only need 2 rows for your revenue. Easy peasy. Either way, all your revenue goes there and gets added to get your total revenue or income. Now, as you can see here in these 4 lines, we've added them all up. They come to our total of just about $1.1 million, which is the gross revenue. After finding your gross revenue here, then total up all the expenses and subtract them from the total revenue to get the profit. Now, as we look over these expense categories here, you can see a lot of them are pretty standard fare for running a business. Things like advertising, accounting and legal fees, electricity, postage, wages, all of these things that most businesses have. The tax bill eventually, which they don't have listed here, but then they will have to subtract from this profit later. So you may not have some of these expenses. If you run a home-based business, then you're not leasing a commercial space. So you won't have rent, for example. Or you may have other things, software costs that aren't listed here, that kind of thing. Determining how to categorize these expenses should become pretty straightforward. You've got is 2 kinds of expenses. You have direct expenses and indirect ones. So the direct costs are what it's going to cost you to sell your product or service. That's the cost of goods sold or the cost of service that we discussed earlier. So if you make pies, it's the raw materials, it's the labor of the baker who went into it, it's the box that you wrap it in. If you sell a service instead, you just call it your cost to produce a service. So if you're a life coach and you provide your sessions via an online platform, then your direct costs would include things like your Zoom membership, the monthly cost of your website. And indirect costs are things that are incurred that don't directly go to the selling of goods and services, but are still required as part of running your business. This would include things like your utilities, your office supplies, computers, rent, all the stuff affectionately referred to as your overhead. Now, both your direct and indirect costs will either be fixed or variable costs. As the name implied, fixed costs are those which don't change. If you lease a building for $1,000 a month, your rent cost is fixed at that $1,000. Your utility bill for your electricity, however, is variable. If it gets really hot where you are in summer, that bill's going to go up if you have to run the AC constantly, right? To sum it up, your direct costs include your manufacturing supplies, your equipment, your raw materials, your labor, other production costs, and your indirect costs are everything else: your utilities, lease space, office supplies, gadgets, marketing, payroll software, insurance, all that kind of stuff. Now, as you can see, once we've added everything up, it costs this hotel a little over $535,000 to run their operation, which we subtract to get their profit and loss. In this case, it's this bottom line here, aka why it's called the bottom line, $575,000. Now, I'll admit, that's a pretty basic P&L. Depending upon what you're using them for and who in your organization is going to see these things, such a cut and dry report may or may not provide enough information. One of the great things about running these reports consistently is how easy it can be to tailor the information to those who make use of it. Now, as the owner, it's probably useful information for you to know how much revenue the restaurant is adding to the hotel to make sure that it's actually making money and is profitable in and of itself, or to see how it performed this month versus the same time last year or last month, things of that nature. What's likely here is that the restaurant is also doing its own P&L. So the general manager of the restaurant can look at his P&L and find out exactly how many of the hummus appetizer he sold since he added it to the menu, and whether or not it's something that should become part of the full-time menu. The bar manager of the restaurant can see how many martinis are selling in order to tailor drink specials and make up sales incentives to get the staff selling more of the espresso martini. Now, you can find a wealth of info depending on how you structure your P&L that can help you to cut costs, increase your revenue, and pad your profits. You can probably agree that as the owner, you would be less concerned with how many espresso martinis are selling. Just as if you're the restaurant manager, the labor costs for house cleaning of the rooms is not necessary information for you. So hopefully you're beginning to see and think of the ways in which you can tweak your P&L to empower your own business and team to make more money. Now, while knowing what your profit or loss was over any one period of time is useful, even better about consistently running a P&L is building up that set of comparative data. The P&L can help you assess the financial health of your business, locate areas for improvement, and help you stay aware of trends and ahead of them. But one standalone report in the absence of comparative data can only be so useful. That's why you want to run the P&L regularly. Okay, so let's say we have this business. We'll call it Francine's Flip Flop Shack. At Francine's Flip Flop Shack, they just closed out their fiscal year and they've run an end of the year P&L. We're going to compare that to the P&L from the last year and see what we've got here. Now remember, your P&L will have more categories and more details, but for speed and ease in this example, we're going to look only at the category totals. All right, so last year, Francine had a total product sales of $100,000, as you can see here. This year, their total sales was $125,000. Now we can calculate the year-over-year change by subtracting last year's sales from this year's to determine a year-over-year change of $25,000. Next, we see last year's cost of goods sold, which came in at $20K, and this year's, which was up to $25,000, a year-over-year change of $5,000 or an increase of 25%. Now that we have these two numbers, our total sales and our direct cost, do you remember what we can find? Our gross profit. Here we see the last year's gross profit was $80,000, $100,000 minus the $20,000 cost of goods, and this year's was $100K. So our year-over-year change for gross profit was $100,000 minus $80,000 or $20,000. So far, so good, right? Pretty simple. Now that we have our gross profit, we can subtract our indirect costs, aka our overheads, to get the operating profit. Last year, Francine's overhead ran $30,000, which left her with an operating profit of $50,000, or the $100,000 in revenue, minus the direct costs and the indirect costs. This year, the Flip Flop Shack had a total overhead of $35,000. Thus, we can determine the Shack's net profit by subtracting the $25,000 in cost of goods and the $35,000 in overhead from the revenue of $125,000, yielding an operating profit this year of $65,000. Once you have operating profit, you can go even further and find your net profit. Subtract the remaining expenses, your taxes, loan repayment, interest, and get your net profit or loss. So now we have the basic data on 2 years, right? What can we learn? Well, sales are up, which is good, obviously. Profit is up as well. But as I hope you're beginning to see, that doesn't tell all the story here. Last year, when Francine sold $100,000, it cost her $50,000 in expenses to do it. Thus, she was pocketing 50% on every sale once her expenses were covered. This year, Francine is actually more profitable. This year's $125,000 in revenue incurred total cost of $60,000. Now, as you can see, the cost of goods went up this year compared to last year. A 25% increase in sales has been accompanied by a 25% increase in cost of goods. Without a P&L though, it's much harder to know. And the more detail you have, the easier it will be to determine what's going on financially in your business. Now, not only did Francine's direct costs go up, so did her overhead. Last year, her indirect costs were only $30,000. This year, they were $35,000, an increase of nearly 17%. Yikes. Again, a detailed P&L will help her figure out where those extra costs are coming from. Maybe she moved the shack into a bigger space and the rent is $400 and some dollars more per month. Perhaps the price of electricity shot up. It could be Francine needed to buy an entire new computer and point of sale system. She might suddenly be paying a lot more for insurance. A detailed profit and loss statement will help to determine all of this. Now, let's move over and look at a more detailed P&L format than what we have been and find something that will paint a more full picture for you. Here you can see I've got a template for a monthly P&L tracker. This is the one that my clients inside my program get access to. And luckily you can get access to it also. The link for that is in the description below. As you can see, we have taken our revenue and expense categories and given them a much more full breakdown. In the template here, there's room for 7 different product or service categories and itemized expense categories. Of course, just add more rows if you need to and more product or expense categories. So this one is a 12-month P&L. It's super easy. You just plug in the numbers and let the spreadsheet do all the work for you. So category 1, you could say you had 100 in sales. Category 2, 500. And as you see, the spreadsheet's already formatted, so it starts to add up things for you. You can put in your expenses here. Say we had $10 in salary, $10 in payroll expenses, outside services 100. And then it goes through, it subtotals at the bottom here, your expenses. It tells you your net profit before taxes. And then you can even plug in your state and federal tax, local tax, anything you need there. And it will give you the total numbers for everything inside your business. So even if you hate math, I think you can see that this requires very little calculating on your end. If you have a business that uses a point of sale system, it likely already tracks most of the numbers you need, and lucky for you, may even already create a P&L. Now, as I said earlier, depending on the business that you're in, you may be running this pretty frequently, or perhaps just monthly or quarterly. You'll definitely want to do it at year's end. Plus, the great part is, once you have all of that data, I know I keep harping on this, but it's so key to making future projections. The template is perfect to use before the start of the new year to make your best educated guess based on how your sales and expenses will go for the oncoming year. Okay, so that's an overview of the profit and loss statement, also known as the income statement. Hopefully now you've got a pretty good grasp on what it tracks: your revenue, your expenses, and your profit. How to use it and what it's good for, like tracking trends, comparing sales periods, keeping an eye on expenses, and on and on. I hope you found this video useful. Feel free to check out my other videos where I go deeper into detail. That's it for this time. Go ahead and download your free copy of the P&L at the link in the description below. And remember, if you're ready to take control of business and personal finance, you can always click the link down in the description to book a time to talk to me and to see how we can serve you.